Trading with Livevol. My name is Stephen Choi, and this is where I use the Livevol X trading platform. I trade my Reg T account, my real live Reg T account, and you guys can follow my live trading every day. Yesterday, as you guys know, I actually do have a full-time job, so I do this part-time, but so once in a while I don't really have time to look at all the markets carefully, and yesterday was one of those days. But luckily, the market didn't do too much, and then I didn't have that great of a day anyway, so there wasn't that much to do. So let's kind of check my account. You can see yesterday I had a pretty big dive here. Today I'm doing a little bit better. Looks like I'm up around $2,400 currently. Most of it is from ZNGA. Let me actually go through some of the. I'm also just start with ZNGA. So this morning when I came in, ZNGA was actually down. I think it traded down to 542. So I started getting worried, so I sold some of the straddle. And just so you guys know that no matter who you are, you can always change your mind. So basically, I sold the straddle for 26 cents this morning, and then when ZNGA started rallying right here, I actually bought the calls back. I forgot I actually had a straddle offer 20 lot more for 27 cents, and then basically that got filled. So I'm going to try to buy this back, but it's pretty high. The stock's run a little bit, so I'm not sure if I'm going to get it. I actually have a 19-cent bid, which I don't think I'm going to get filled, as well as I don't really want to get filled. But I do want to start buying these back, the March 5.5 puts. As you guys know, last week I sold the 5.5 calls thinking it ran a little too high, and then it came back, so it worked out. And then I had this naked position because I thought it was going to go up. Yesterday wasn't that great of a day. I think I lost about $900 on P&L, but looks like today it's making it up for me. So that's good news. I think it might run up to $6, so I'm kind of waiting for it to run up to $6. As you can see, the order flow is extremely bullish. If I look at this, people have been buying the 6 calls, the 5.5 calls, selling the 5.5 puts, selling the March 6 puts. So every order seems like it's super bullish. One of the reasons why I wasn't as worried, and I know a lot of you guys, people talk about skew and people don't know exactly what to use it for. So let me actually draw it up. So this is the skew chart, right? And then you see each month right here. Let me actually make it easier by eliminating some lines, right? So the reason I wasn't so worried is usually it's the put side that have a much higher and steeper curve on the skew, not the call side. So when I looked at ZNGA, it was the other way around. It was the calls that had a really high curve, and it was the put that had a flatter curve. So if you look at the April 5.5, right? It's if you look at its 53 vol, the calls are 54 and the puts are 55. Now you see how this is more aligned to what it should have been. This morning it was completely opposite. So basically the upside calls were flat and the really high, and the puts were flat, which made me think that the chances of it going further down was low. So since then, since it's rallied basically 40 cents, like over 5%, this skew actually went back to normal. So if I wish I took a picture this morning, but this morning, this green line, this yellow line was more flatter, and these call lines are very steep. As you can see, on the March 22 calls, the call line is still pretty steep, and so we'll see. So like you see how this is the 6 calls right here at 56 vol. This was actually higher. So it's one way I use the skew to try to find out which way the volatility is leaning, and it usually gives you some good clue as well as the order flow. So this morning I sold the spread because the skew was kind of like inverted where the calls were higher than the puts. So I was pretty confident that it wasn't going to go down too much further, and then I saw all these bullish orders come in. So I pretty much bought back the March 5.5 calls. Let me actually see. So you see me selling these at 16 cents. So that was this morning. These puts, I sold them for 16, and then where's the calls? Right. So you see these March 5.5 calls. I sold them for a dime. So I sold the puts for 16. I sold the calls for a dime. Here I sold, for a dime for 26 cents total. And then when I saw ZNGA go back up, I just bought it back for 16 cents. So I just changed my mind on my position, and now what I'm gonna do is I'm gonna see where this ends up. Hopefully it'll go up to $6. I'll try to buy the puts back, and then I'll just start selling some calls against it. This is my risk chart right now. Looks like if it goes up to $6, I might make about $2,000 more. As you can see, my downside has significantly increased to like 5,000. So I think what I'm going to do is I'm going to start trying to buy these back. So if I bought 70 of these back, and then now I look at the risk chart, my downside goes from 5,700 to like 3,000. Just because I paid $210 if I paid 3 cents for these. So $210 can actually save me half the losses if something bad were to happen. So we'll see what happens. It's kind of halftime. Hopefully there'll be one more push to the close, but we'll see. The market itself looked a little weak today, so unless the market really bounces back, not sure what's going to happen here. So that's ZNGA. I also did an FXI trade. So for those of you guys who don't know what FXI is, it's the ETF for Chinese shares. And yesterday, some guy came in and did this put spread, ratio put spread. And I think I talked about it yesterday, where the guy sold the April 35 put and bought 2 of the April 33 puts for 23-cent credit. So basically what I did was I put it in there, but I wanted to do it for a better price. So I got like 27 cents credit. And the thing I like about this is I'm piggybacking this person's trade, but it's literally a straddle. So this person is saying by April expiration, FXI is going to be below 33 or above 35, and that's his bet. And I kind of agree. Let's see what the trades are so far. So it looks like a lot of puts are being traded. It's down by a little over 1%. So we'll see what happens. If I look at the chart, it's kind of on a downward movement. Let me actually punch it up here. There you go. Yeah, so basically this could actually go straight down, or it's going to go straight up. This person is betting that it's going to be outside of this 33-35 range pretty much a little over a month from now. I also did an AA trade, Alcoa. So as you guys know, there've been a lot of bullish orders. So I had this original position on this. It was funny because I want to buy these March 12 calls, and my friends at Trade a Minute, they bought the March 11 calls. So I kind of piggybacked theirs. I kind of piggybacked the order flow here. And today I bought some more for 4 cents because I saw all this buying. So you see these buying lately. So in the morning they were selling, but they were buying. And maybe I was thinking there might be a little rebound. So it was worth kind of putting in more money and kind of leveraging what I've made so far into more calls. So we'll see what happens in Alcoa. Another stock, and this stock isn't actually working out as well as I thought. This outer wall, I remember telling you guys about the Dutch tender, and it's actually at the lowest price where they would be willing to pay. So at the Dutch tender, it was I think it went off at $70. So it's it's $4 lower than where the tender went off. If you look at it, the chart itself looks kind of pretty bad right now. And I look at the order flow, and they're pretty bullish still. So even though the stock has underperformed, looks like people are still betting to the upside, which makes me feel okay about this, and I'm just debating whether I should do more. But right now, when my premise doesn't work out, I'm less confident about putting on more positions. So for now, I'll just kind of keep an eye on it, and I'll see how it goes. And if I see it rebound a little bit, maybe after it rebounds is when I might actually start putting some more bullish bets. So you see how it dropped? It actually is in a downward trend. So until that ends, I don't think it's a wise move to bet unless you had some other information that was very useful. One other thing, as you guys know, I have a lot of long positions. So all my positions that are long, almost all of them, are hedged by this VIX position. And it's not a perfect hedge. It's just a rough estimate, but I bought the April 1626 calls. As you guys know, I owned the March 1626 calls earlier for 70. I sold them out for 65, and I rolled them into these for about 115. And let me actually punch it up right now. So I own 20 of the spread. I paid about $2,300 total. It can turn into 20 grand. So if something crazy happened and the VIX went above 26, I should make 18,000, and that should hedge all my long position that I have currently and accumulating as it goes. So I'm still bullish for now, but obviously just to do it naked is a lot riskier. I just want to talk about GM real quick because it's I rolled into these 39s after making 500. I put them all on this, and as you can see, it's pretty much nil now. So I doubled up and I lost. So it doesn't look like I'm gonna make too much, but I'll see what happens. The thing that I am excited about kind of is Apple. So for those of you guys who trade Apple, and I'm sure there's a bunch of you guys, I originally did this spread, right? April 510, 530, trying to buy more spreads as Apple went down, but it looks like I got an upgrade today, and maybe it might actually be on an uptrend. So if I look at the weeklies, you see how it's like made this little bottom. You know, I'll see how the volume is. You kind of would like the volume to increase as the stock's going up, but we'll see. It's only Tuesday, so, and if I look at the dailies, looks like this is going to have a pretty good day. So this might be a pretty good indicator that it might go higher, and I think it is going to go higher. And if I look at, so what I did was I looked at the order flow in Apple, because I always try to confirm it. And it was kind of, it wasn't as definitively strong to the upside as I wanted, but you know, it's still net long delta and people are buying premiums. So what I was thinking was I would like to do more spreads. So if I like the 510, 530 spread, I was thinking of maybe going further out than the April, maybe May, and doing maybe the 520, 540 call spread. I see it's the fair value is $11. So what that means is if I buy the spread by May expiration, Apple has to trade higher than 531, and if it trades 540, I'm gonna make, let's say I paid 11, I'm gonna make 45% return in a couple of months, which isn't too bad. So I'm actually gonna put in a bid. I think I'm gonna put in 1075. Let me see how this tick chart looks. You know, this makes me think like it's gonna go here and then like it's gonna get jacked again. So but I'm gonna do the prudent thing. I'm usually impatient, so I'm always like reaching for it. But I'll pay 1080. I'll send the order right now. Boom. All right. So hopefully I get filled. I'm almost tempted to kind of take a shot at one of these weekly calls, but you know I've done these in the past and it hasn't really panned out well for me. So I'm gonna restrain myself from doing so. Maybe I can sell some put spread. Might be another one that I'm thinking of, because if this had this bounce, you know, depending on how much, there's like this like very support right here around 530. It's not a huge support because it's only been there for a very short time, and it's an intermediate support. So I might put on a bullish bet, but if it bounces back down, then maybe I'll get out of it. But for now, I'm gonna just try to work the call spread and see how that goes, and hopefully I get filled on a little down move. So a lot of times, one of the things that people ask me is, I know you guys had this before, where you're not sure what to pay for on these kind of spreads, right? Basically, the calls and puts are the same. They're tied together. It's the way the formula is set up. It's put call parity. It's something that if you are a professional trader, you kind of know inside and out. Back in the day when you used to stand in the pit with a piece of paper like I used to, it's a little different now. It's all computerized, so people don't even have to do the put call parity anymore. They just kind of have the electronics system do the execution. But for you guys Since the interest rate is added to this, but since the interest rate is 0 and this is a front month, I'll just give you guys a quick tip on how to actually execute these trades. So you see these March 5.5 calls. The fair value is 32 cents. So if you add 32 cents to 550, you have 582. You see this? 582, and the stock is trading 578. That means there's 4 cents intrinsic that you're actually paying above, and that's what the put is. So for a professional, what I do is I'll buy the calls or the puts, and I can turn them into calls and puts by using stock. So if I buy puts and stock, and I'm going to go, it could be a little confusing here, but stay with me. If I buy puts and stock, it's same as buying calls, according, if you look at the P&L graph. So what I do is I try to do, if I want to be long these 5.5 line, I can either do it by buying puts and calls or buying the calls outright. So for example, if this was 35 bid at 37, I don't want to pay 37 cents and pay 7 cents above the stock price. I would rather just buy this for 4 cents, buy the stock, and then I'm synthetically paying 34 cents for this option. Now, I probably lost like 80% of you guys right there, but the most important thing for you guys to understand is when there's a definite relationship between calls and puts. So if you guys want to pay, if you guys are trying to figure out how much you should pay, add the intrinsic value of the put to the calls, and that's most likely the fair value, right? So if you actually click on this and see where most of them is trading, you see how it's trading like 32 cents? It's 3 cents above the stock price, so 3 cents of intrinsic value. So you can see that's 3 cents at 4, so it makes sense. Sometimes when it gets really wide, for example, let's say you want to trade something that's more in the money, right? So like this one, right? The intrinsic value in this one is basically 179, right? 179 plus 4 is 579. If you know that these puts are basically worthless, right? If you put in a bid for 179, you probably won't get filled, because as a professional, why would you buy that if it's same as doing this? So what you can do is you can do a penny higher, and you can figure out by adding 1 more cents to the intrinsic value that you're actually giving somebody an extra premium. So you're giving them a penny to execute, which I'll do gladly as a professional trader. So it's a one little tip for you guys if you guys want to know which price you should do it at. So I'm looking at ZNGA right now. Looks like it's kind of ready for another up move. I'll see how it goes. But I'm going to keep track as long as. So today looks like I'm having a decent day. GM not that good. Outer wall not that good. RSX, as you guys know, I rolled it down to 22. I'm kind of glad I did. And then the VIX, Yahoo is another long call position that's not really performing that well, but I'm hoping it bounces back, and then bulk of my profits are in ZNGA. So hopefully, ZNGA will keep going up, and if it reaches $6, I probably will start selling some calls to flatten it out. So right now, this risk chart, if you look at it, if it goes to $6, see how I'm like long 10,000 delta and I'm long 6,700 gamma. So at this point, I'll probably start unloading some options to flatten this out a little bit. This way, no matter what happens, I can actually start making money. And the skew chart right here is telling me it's back to normal, right? So you see how now the skew chart is like actually acting more like a normal stock, where the puts are higher than the calls. But this morning it was the other way around, which made me bullish on the stock. So hope this helped. For those of you guys who want to try out Livevol X, you can do so pretty easily. Just go to livevol.com, Livevol X, and then click on the free trial, and then you guys can try it out. It's a pretty awesome software. I say that every time, but I just gotta say it's pretty much the best software out there if you're trading options seriously. So I hope everyone's trading is going to go well for the rest of the day, and I'll talk to you guys tomorrow. Take care.